Onward and upward. For the most part, that has been the story of the stock market so far in the new year 2018. As I said in my 2018 forecast show a few weeks ago, this froth on what I consider to be this overvalued market could, yes, continue to build up for quite some time. But beneath the froth, the story also remains much the same. An economy on the mend, but still not quite strong enough to justify Wall Street's euphoria. Will that change once President Trump's tax cuts really kick in? Can the markets make fundamental sense again without a major correction? And most importantly, what might the answer mean for your retirement plan? It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional-style investing to your portfolio. Hello, everyone, and welcome to the Income Generation. I'm David Scranton, your host. Now, most of you probably remember Bill Clinton's famous line, "It's the economy, stupid." And you know, usually it is the economy more than anything that determines really the approval rating of a president. That has some pundits wondering why President Trump's numbers are still at 40% at a time when the economy is supposedly booming. Well, just like almost everything else having to do with President Trump's presidency, old rules and formulas don't seem to apply. The explanation probably has a lot to do with Trump himself, but it might also have something to do with the economy's supposed strength. We'll get to the bottom of it all today and much, much more with the help of our guest, David Hightower of the Hightower Report and investment specialist Paul Legenda. Let's take the economy a closer look first and why Wall Street is so excited about today's economy.
A new national pride is sweeping across our nation, and a new surge of optimism is placing impossible dreams firmly within our grasp. What we are witnessing today is the renewal of the American spirit. Our allies will find that America is once again ready to lead.
Yes, the American economy is roaring back. That's what President Trump told leaders at the World Economic Forum in Switzerland recently, and he reiterated that on his message in the State of Union address just a week later. And by some measures, one could make that case. Consumer spending has increased. The unemployment rate is at a reported 4.1%, the best it's been since before the Great Recession. GDP growth hit 3% in 2 of the last 3 quarters, and a lot of pundits are banking on President Trump's tax cuts to make everything even better. All those factors appear to be painting a rosy picture, but yet not every economist is sold. They're certainly not sold on the idea that the stock market's sky-high numbers make sense compared to the economy's numbers, or that the former is a direct result of the latter. President Trump himself likes to tout this idea in speeches and his tweets, like this one. Economy growing, stock market at a new high, unemployment at a low. We're winning, and tax cuts will shift our economy into high gear. And it's not just experts who aren't sold on the idea that the economy is as strong as President Trump and Wall Street say it is. A lot of everyday Americans aren't sold either, having seen 2 other major market booms go bust since the turn of the century. Now, that may explain, at least in part, why President Trump's approval numbers are so low despite the economy's relative health. It may also partly explain why GDP growth in the 4th quarter of last year was lower than expected. 2.6% actually, according to the Commerce Department, after hitting 3.2% in the 3rd quarter. And yes, consumer spending was up, but that's generally a given in the 4th quarter of every year due to holiday shopping. But beyond the natural cautiousness created by 2 major stock market corrections since the year 2000, there are other details driving the skepticism about the so-called roaring economy. Take these 2 charts, for example. Unemployment is at its lowest level since before the Great Recession. But as you can see, unemployment has been dropping steadily since the peak of the recession in 2010. This isn't really a new development per se of the Trump era. By the same token, if you look at this chart, you can see what other analysts have pointed out many times about the high-flying stock market. Like unemployment, it too has been on a steady tear since long before the President Trump's election. An upward course marked by occasional small downturns, but lasting typically no more than just a few weeks. And that's partly because the economy has also been improving steadily, although very slowly over all that time. But it's also due to the fact that following the recession, artificial stimulus measures like quantitative easing became more of a driving force for the stock market than actual economic factors. And that really hasn't changed. In fact, as I pointed out many times on the show, the impact of President Trump so far on the markets has been far more artificial and based on hope than genuine. It's hinged mainly on his promise to deliver 4% growth over the long run. And we're really nowhere near 4% yet. And many economists remain skeptical that his tax cuts can get us there. That's why I characterize all the growth we've seen since the election and are continuing to see as froth. Basically a huge head of foam on a glass that was already full. But what are some other details about the economy that illustrate why it can't really be the driving force behind the soaring market? A number of them were highlighted in a report in the publication called The Week recently. The report used a metric that I believe is critically important to any good analysis, and that is history. Among its findings, from 1948 to 2006, inflation-adjusted GDP growth was 1.91% per year, according to the Bureau of Economic Analysis. But in the following 10-year period from 2007 to 2016, adjusted growth was a terrible 0.61% on average. Now that's partly a result of the Great Recession in the early years of the decade, but even without that, an average growth from 2010 to 2016 would have only equaled about 1.4%. And that actually supports another point that I've made many times, that even as recently as 2016, we hadn't really completely recovered economically from the Great Recession. All of the Fed's tinkering with quantitative easing, all it did was really to create an artificial asset recovery, but not an economic recovery. So has that all changed since President Trump's election? Well, full data for 2017 isn't in yet, but preliminary growth estimates are only modestly better than an average 2.6% for the first 3 quarters. What about productivity growth, which measures the hours put in by U.S. workers? Well, from 1948 to 2006, it increased by an average of 1.96% per year. But then from 2007 to 2016, it averaged just a 1.23% annual increase, with 2016 marking the worst individual year at an increase of 0. That increased to only 1.1% again in 2017, better but still far from great. So now let's take a closer look at jobs. You saw by the chart earlier that unemployment has risen overall since the last 10 years, but the question becomes, how do the actual numbers compare to historical averages? Well, from 1978 to 2006, America averaged 1.04 new jobs per 100 employable workers per year. But from 2007 to 2016, it averaged just 0.38 new jobs in the same metric. And estimated figures for 2017 are right in line with that average. So what's my point? Well, as the article in this publication called The Week points out, a decade in which per capita growth clocks in at less than 1/3 its previous average, productivity less than 2/3, and job creation just over 1/3 unquestionably qualifies what's going on right now as a Japanese-style lost decade. And 2017 has been about average compared to the past few years. The author rightly goes on to weigh in that what's really needed to break America out of this rut is a huge surge in all of these indicators sustained over many, many years. Instead, one could argue we're already well into a second lost decade and could stay there indefinitely. But the question becomes, what about those corporate tax cuts, which President Trump talked a lot about during his State of the Union address, and as we fully expected? Won't those tax cuts change everything and help the economy quickly catch up with all that froth on the overvalued market? Well, not everyone is sold on that idea either, as we'll talk about just a bit later in the show. Right now, let's welcome our first guest for today, David Hightower. David Hightower is the founding principal of the well-known commodities research and information firm, the Hightower Report. He publishes one of the most widely read daily commodity wires in the world, which is used by many brokerage firms as a primary source of research. He examines financial, agricultural, geopolitical situations around the world, which allows his company to provide analysis and commentary on a wide variety of markets. This includes grains, livestock, precious metals, currencies, bonds, and of course, the stock market. David, welcome to the show.
Good to be here.
Most people at least have heard of the Hightower Report, but for those who aren't familiar with it, what should they know?
Well, we do a lot of hard work, and we do what I think is real market analysis. We pour through the details. We listen to the markets. We have a tremendous amount of experience, 36 years myself. And I think we're a blue-collar economist. We look at the basic principles of the market, but we also seek verification by the hard nuts and bolts on the ground.
So tell me, in 36 years, have the financial markets changed in any fundamental way since you've been doing this? And if so, how?
Definitely they have. Well, logically, the globalization is obvious. The other fact, though, the markets are much quicker now. The markets look further forward. They have a lot more geopolitical and just wide diversity of information to absorb. But they also have a much more potential for what I'd call boom and bust. So the rallies are bigger, the breaks are steeper.
Yeah, and part of that's probably just people being not as long-term based as they had been, years ago. So do you think net, is that a good thing or a bad thing for everyday investors?
I think it might be a bad thing for everyday investors. I try to look at the bigger trends. I try to use the daily action to kind of confirm whether my thinking is accurate and what the market thinks. I think that's always important.
How about so far since the turn of the century? Have you seen the markets changed fundamentally since January 1st, 2000?
Well, logically, we had two major negative events that really injured sentiment. At one point, the markets were expecting some depression of sorts, and so it was probably the worst economic situation in 50, 60 years. But all things considered, I think they've rebounded rather quickly, and as Goldman said today, I think we're maybe beginning to see a reflation.
Reflation, wow. Hey, David, I know you're on a time crunch today, but can you stay with us for just one more segment? We need to take a quick commercial break. Great. And you too, I want you all to stay with us too. We have a lot more with David Hightower as soon as we come back. We'll be right back. Welcome back to the Income Generation. As we talked about earlier, market performance since President Trump's election has been based much more on hope and optimism over his ability to grow this economy than on actual economic growth. The cornerstone, of course, of the economic plan is massive tax cuts. But it wasn't even approved until about a month ago. Now, while plenty of pundits and politicians, including President Trump himself, expressed confidence that this tax plan will deliver the kind of growth needed to eventually justify the optimism we've seen across Wall Street, there are many others that are skeptical. But what does history tell us about President Trump's approach, which is basically the same kind of trickle-down economic policy put in place by President Reagan and later by George W. Bush? Many historians maintain that Reagan's plan, known as Reaganomics, worked and helped end the 1980 recession. Reagan cut the top tax rate from 70% to 28% and reduced corporate taxes from 46% to 40%. At the same time, however, President Reagan increased government spending by 2.5% per year and almost tripled the federal debt. According to a recent analysis by The Balance, that spending increase probably had as much to do with ending the recession as President Reagan's tax cuts. As for George W. Bush, he used tax cuts to help address the 2001 recession. It seemed to work, but don't forget that at the same time, the Federal Reserve lowered federal funds rates all the way down from over 5% to 1%. So from a historical perspective, it's unclear whether the tax cuts or monetary policy was what was driving the force behind the recovery, or perhaps a combination of the two. As for President Trump, he vowed again in his State of the Union speech to increase spending for infrastructure and the military. But that may be easier said than done in light of our current $440 billion federal deficit. And rather than lowering short-term interest rates, this time the Fed is eager to continue raising them. So eager, in fact, that I've talked about this as another potential headwind for the economy. If they should hike rates to an all-time high soon, a new high, we could end up with a flat yield curve, which, as we've discussed before, could be a major setback to growth. In fact, one could argue that the flat yield curve is happening based upon current Treasury yields. The 2-year Treasury yield is just shy of 2.2%. The 10-year Treasury yield is up now over 2.7%, and the 30-year is still shy of 3%. Meanwhile, the federal funds rate is still at 1.25% to 1.5%. So that's already pretty flat. Don't forget that only 6 years after President Bush's tax cuts helped pull us out of the 2001 recession, the housing crisis hit and the stock market experienced its second major downturn of the century, an almost 60% drop. Now, if you're a regular viewer of this show, you already know that I believe a third major drop is overdue. Although we may not see it in 2018, investors with 10 years of retirement should keep in mind that the potential does exist and should weigh the risk of another possible 10% market gain against the risk of a 50% or greater market drop. Now, if you saw my 2018 market forecast show a few weeks ago, you may recall my forecast calls for the stock market to have a double-digit year. The catch is it could be double digits on the upside or on the downside if the tipping point should occur. There's also one more little red flag that could spell trouble for the economy and force the markets to make fundamental sense again with a major pullback. This one has relevance for the income generation particularly, so make sure you stick around. But right now I'd like to welcome back David Hightower. David, before the break you had mentioned something about reflation, a term that I'm sure a lot of our viewers have heard of but might not understand completely what it means. Can you give us a quick Cliff Notes definition?
Well, I mean, we've come from a long period, as you indicated in the prior segment, a deflationary scenario where we had a lost decade. We pressured prices. We had demand that was so soft that prices would just favor the downside. So we see very little inflation. We see very little upward pressure in prices. But now we're going from holding the beach ball underneath water to seeing the beach ball rise back to the surface of the water, and that comes with wages and commodity prices and interest rates, energy prices, et cetera. It's called reflation, and I think that's upon us, and it will translate into more solid growth going forward.
So you've seen, have you seen the same disconnect that I've been seeing, at least for the last year and a half, between economic growth and stock market growth? Or do you think that the stock market is fairly valued where it is today?
Well, I don't think it's a disconnect. I think that we have the timing. We expect the timing to be immediate. The stock market, the futures markets, economic forecasts are forward-looking, not backward-looking. And the stock market is discounting the future. And, you know, I've traveled 190,000 miles in 3.5 months, I think some 23 countries, China, extensively. And this global synchronized growth is not something to be discounted. And I verify that. I look at how much throughput do we see in crude oil, what kind of consumption we have of soybeans, what kind of consumption of beef. So it's real, even though some people want to continue to doubt that.
So if you feel as though in the next year or two the economy will grow into the forward-looking stock market values of today, then the question is how much more upside does the actual stock market really have? If the stock market's kind of already factored in this economic growth, then do we see ourselves at least getting back to more normalized growth cycles in the stock market over the next year or two? What are your thoughts?
Well, not to be clipped about it, but you know, it'll keep going till it stops. But I think that it depends on well, how strong and how long is the recovery going to be. But I don't see it ending in the short term. And today was a good example. We saw Treasury yields break out to the upside, at the same time that the Dow made new highs in the day. So we're at this inflection point now where yields are starting to creep higher. They could attract some money away from the stock market, but that doesn't mean in the near term, perhaps another 2 or 3 months, that interest rates could go up and the stock market could continue to go up. So I continue to watch every day to see if perhaps the situation's coming apart for the bull camp, but it doesn't appear to be yet.
We broke through a key resistance level, as you know, on the 10-year Treasury rate just in the last week and a half or so. How high do you think the 10-year Treasury rate will go on this level? If you had to forecast that, where would you put it? 3, 3.25 before it backs up again? You tell me.
Yeah, I mean, it's going to be begrudgingly go higher because the central bankers are, they're maybe not tapping on the brakes any longer, but we haven't seen a concerted effort to begin to rapidly remove quantitative easing. So I think it's going to be a very slow and gradual climb out when it comes to yield. Sometimes, though, the market, the cash bond markets globally, actually go do the Fed's work for them. So it could do that. It could do those 50 basis points, as you indicated, if the trade begins to see that from the ECB, Bank of Japan.
In the last 15 seconds or so we have left, are you concerned at all, as I am, that if we don't get the growth that the markets are predicting, again, forward-looking, that we can end up ending up with a flat yield curve?
I think the flat yield curve has absolutely no credibility in the marketplace. We're coming off a historical quantitative easing, a floating of debt, a artificial suppression of what's going on throughout the interest rate structure. So I don't know. I think, but I also think that the U.S. is not the primary game any longer, and sometimes we infatuate ourselves with what is going on with our yield curve. Yeah,
that's very, very true. Of course, a lot of sovereign yields in other countries theoretically weaker than ours are actually even lower. So it's great. That's why I love having people on the show that have different points of view. David, it's been wonderful. We'd love to have you on again the show sometime. So thank you for being here. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Hello, I'm Miranda Kahn. Let's take a look at some of the stories that move the markets this week. The Federal Reserve keeps interest rates the same, but predicts inflation will rise this year. It's a sign the Fed will likely raise borrowing costs next month under the incoming chairman, Jerome Powell. The Fed expects the economy to expand at a moderate pace due to solid gains in employment, household spending, and capital investment. Apple is cooperating with the U.S. government's probe into the slowdown of older iPhones. The tech company apologized for its 2016 software update that slowed down the phones in an effort to keep them from shutting off. However, Apple didn't tell anyone until last month. It has since cut the price of replacement batteries nearly in half. CNBC reports Sears is laying off more than 200 people from its corporate headquarters in Illinois. The layoffs are part of the ongoing restructuring plan announced last month. Sears is attempting to streamline operations to start making money again. The retail chain hasn't turned a profit in the last 6 years. As always, for much more on these stories, please visit newsmax.com/finance.
Welcome back to the Income Generation. You know, we've already mentioned that consumer spending was up in December, even though overall GDP growth for the fourth quarter came in lower than expected. But a lesser known detail about the spending increase is that it came at the expense of savings. In fact, according to a recent report by the Bureau of Economic Analysis, savings actually dropped to a 10-year low, which could be another bad sign for future spending and economic growth. Now, this might be seen as a potential downside to the wealth effect, which I've talked about many times before on the show. The wealth effect theorizes that people are more likely to spend when the stock market's up and their 401ks are doing well. Why? Because psychologically they feel wealthy. The wealth effect was supposed to help spur recovery after the financial crisis, in fact. But by lowering interest rates to near zero, the Fed basically forced investors up the risk curve, meaning into the stock market, by making other investment options appear less attractive. While that did help the market grow, as we discussed earlier, it didn't do much to help the economy itself because consumers were reluctant to start spending and borrowing again just because of low interest rates. Instead, they focused on recouping savings that was lost in 2007 to 2009 when we had the big market crash, and they focused on paying down debt also. The increase in consumer confidence since President Trump's election suggests people are willing to spend again. But most of those same people probably haven't seen their wages increase by much, if at all. That means a lot of them are dipping in the savings to increase their spending, much like we had back in 2006. According to that report, a recent report by the Economics Bureau, household savings have fallen to their lowest level since December 2007, when the economy slipped into the Great Recession. So if Americans have so far been going into their savings to increase spending, that means that medium incomes are going to have to increase soon in order for the spending to continue and for growth to accelerate. Yes, the president's tax cuts will probably help that, but will they help enough is the question. And that remains to be seen. What's most concerning about all this from a financial advisor's perspective is the idea that some Americans may be drawing down on their savings at a time when they can least afford it. If you're retired or within 10 years of retirement, for example, you shouldn't have to be drawing from savings at all to make expenditures. For most people, your money should be invested in such a way that the principal is secure and generating, hopefully, enough income through interest and dividends to satisfy all your spending needs throughout retirement. And as I've discussed before on the show, spending down on principal when you're retired or near retirement can be a very slippery slope and should be avoided at all costs. Now it's time to welcome to our show Paul Legenda. Paul is a certified financial planner, national seminar leader, author, and consultant. His specialties include investing and home and business issues, and his books include High-Level Investing for Dummies and Stock Investing for Dummies, which was named one of the top 10 books for investors by Barron's. He's appeared on all the major networks, and his blog is called ravingcapitalist.com. Paul, welcome to our show.
Oh, I'm thrilled to be on. Thank you for having me.
You know, I need to ask you a favor, though, when we start, if that's okay. Can I ask you a favor?
Go on.
Can I just call you Paul Smith for the rest of the show, please? It would make it a little bit easier for your friend, the host here, if that's okay.
Listen, Paul or Hey You works for me. It's just a pleasure to be on. Thank you, Dave.
You're very welcome. It's great to have you. So Paul, as a raving capitalist, I expect that you're pretty pleased about Trump's tax plan having gone through. Question is, are you confident that it can deliver the kind of growth he's promised? And if so, how long do you think it might take?
Well, here's the thing. When you're talking about a tax cut plan like such as he has, and you could have had derivations, some better, some worse, etc. But the bottom line is that when you're keeping more of the capital in the economy, because what are we talking about when we talk about taxes? Those are basically what? Coercive payments that take money out of the private economy and put it into the public economy or the government infrastructure, basically.
Sure.
So if you want the economy to grow, the more capital you can keep in there, the better. And in addition, because taxes, see, a lot of people sometimes debate taxes from like a mathematical point of view. Oh, there's too little, too much, etc. But they forget that taxes, especially tax cuts, create a powerful incentive for production. And really, the cornerstone of success for any economy is production. The more you could grow, the more you can incentivize that, the better. And when people know they can keep more of the fruits of their labor, that's another powerful incentive. So for me, I think tax cuts are typically, on balance, usually a good idea, and in many cases, a very powerful idea.
Okay.
So I like them. So they will have, I think, a good long-term effects that'll be great across the economic landscape,
Paul,
without a doubt.
So we're redistributing wealth from the government pocketbook into the pocketbook of corporate America and into the pocketbook of individuals. So the problem now is, how about the budget deficit? Is this going to become a bigger issue, or do you really think that we can grow our way out of this expense?
Believe it or not, I think that if nobody else is tweaking this for the long time to come, you're maintaining spending at or below the level of inflation, you could at some point down the road be able to, ironically, grow out of it and even have yourself a surplus. You see, a part of the tax debate, and I'm doing what I'm doing now. For 25 years, I did taxes. I know the impact of this for individuals and small businesses.
Sure.
And the point about tax rates, you're lowering tax rates. Many people, including financial advisors and commentators on the networks, they confuse tax rates with tax revenues. And many people think, well, you're going to lower tax revenues. Well, no, you're not. When you lower tax rates,
short term, you will lower tax revenues. The question is, long term, can you then turn it around and increase tax revenues?
Oh, no, absolutely. I mean, think about it this way. Whenever you have a corporation, for example, that needs more revenue, what do they tend to do? Because they can't force people to pay and buy their products and services, so they tend to lower prices. So then all of a sudden, they get more revenue. So this is why a company like Walmart tends to make more gross revenue than a company like Tiffany's or these kind of venues. So tax rates have, when you're lowering prices, you get more of that activity. Companies tend to hire more people. They tend to expand their operations, which means then you increase the tax base. So ultimately, you do increase in the long run tax revenue.
Yeah, I like that analogy. You're right. It's much like in a business. It's very much the same. I want to break down two more things with you, but we have to go to commercial break in just about 30 seconds. So, bottom line, what do you think about the stock market in 2018? Do you think it'll end the year up or down? Give us the bottom line answer, and we could break it down a little bit more in the next segment.
Oh, I'll look forward to that. So, did you want me to tell me now, or you want me to wait till after the?
Sure. Do you think, bottom line, do you think the stock market's going to end the year higher or lower?
I see it being in a flat range by the end of the year. All right, but I'll tell you more afterwards, I presume.
All right, sounds good. That's great. Stay with us, Paul. Thank you. And you too stay with us, our Income Generation members. We have a lot more. We're going to ask Paul about the stock market, the bond market, interest rates. You're going to want to hear what he has to say. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Let me tell you Mickey specials today. We've got steak and eggs served with some home fries and Mickey waffles.
Woo! I love me some steak and eggs.
Ever since they found mad cow disease in the U.S., I'm not taking any chances. It can live in your body for years before it ravages your brain.
Ah, yes, we all remember Debbie Downer. And believe me, I realize that I and other advisors who focus on protection and income can sometimes come across as Debbie Downer when we talk about stock market risk in the midst of a rally like the one we've seen over the last couple of years. But the reality is, there is a certain level of risk in virtually any type of investment. And the factors that can increase risk aren't always known or apparent to most investors. That's why it's especially important in times like this to focus on the right details. Or, if you don't know what all those details are, then make sure that you have a financial advisor who does. We've examined a lot of the relevant data and details related to risk on today's show. And when you put them all together, the bottom line is that the soaring stock market, in my opinion, still doesn't make fundamental sense. It's kind of like the old magician's trick where the magician levitates a woman in midair and runs a ring over the length of her body to show that there's nothing holding her from above or supporting her from below. The market might start to at least make more sense if the froth were to stop building for a time, so the modest improving economy could actually catch up to it. But guess what? That hasn't happened yet. This is still a market influenced more by hype, hope, and emotional factors than by fundamentals. And that, yes, increases its risk factor, especially for investors close to retirement. And that's why myself and other retirement income specialists are probably going to continue sounding like Debbie Downer until things start to make fundamental sense again. That will happen either through an economy that suddenly soars proportionally with the stock market, or a market that corrects itself enough to align with economic reality. But now, let's welcome back my new friend, Paul Legenda. Paul, I have to ask you now, are you of Polish descent? Is that your last name?
Yugoslavian.
Yugoslavian.
All right. More specifically, Croatian.
Okay.
All right. I was born in a communist country. That's why I refer to myself as a raving capitalist. That's actually how you become a raving capitalist.
You see, the reason I was asking was because I thought maybe it was Polish descent. I'm 3/4 Polish, and I was going to say I thought that it was just perfect that a Polak like myself be writing a book about investing for dummies. But I guess my whole joke is gone now because you're not Polish, but that's okay. So you think the market
still works for me?
Yeah.
Well, you're a brother to me. We're Eastern European.
That's
Go
right.
get him, Dave.
That's right. So you think the market's going to be fairly flat this year. And it's interesting because our last guest, David Hightower, thought that the market was going to keep roaring along. Yes, the market's forward-looking, so the market now is a little ahead of the economy, but he thinks the economy is going to grow so much that the market's going to continue to grow. It sounds like you're saying that the economy might grow into the market, but in 2018, that's about it. Is that what I'm hearing you say as far as the stock market's concerned?
Yeah, well, here's the thing. Here's my concerns about the stock market. Obviously, it's a great stock market. You know, I consider myself bullish. Could it go to 27,000 or 28,000? You know, I think it has a strong chance for that. But I see a lot of things that are worrisome to me because I feel that the stock market could have shrapnel effect from some other markets.
Yep.
I think that the bond market is going to be a huge problem in rising interest rates, and that's going to start tempering things in my estimation. So it should be a good year for the stock market, but there are dangers that are lurking out there that could prevent it from going to where some people when everyone starts talking about being 30,000 and beyond. You know, we have to be careful because there's a lot of things come into play. More people are borrowing, you know, on their stocks than ever before. There's a lot of things out there that could really be a fly in the ointment.
So if you're saying 27,000, well, then that's only a couple of percentage points above where we are today. So the question then becomes, what are those things that concern you about the market? What's the biggest one? What's the biggest one right now that has your concerns about the market for 2018 or maybe even into 2019?
Well, I think the bond bubble, personally. I think there's a tremendous amount of debt. And, you know, and the point is, I don't know how it's going to be paid back. And if interest rates start to rise, that's going to cause some real problems in those venues. And when that starts to occur, then in many cases that could have like a shrapnel effect on the stock market. All right, because I think the stock market in and of itself, if it was inside a bubble, and I'm not calling it, and I don't mean, you got to be careful I use the word bubble, but inside of itself, I think it has strong potential because the main point that's going to be giving it support is going to be the economy. The economy, I think, will do well with the stock market. I tend to feel to a lot of extent what that a financial advisor might expect. But I think there's going to be a lot of things tempering it going forward. And the bond bubble is one of my biggest concerns going forward, and rising interest rates.
It's interesting because historically, if you have a bond bubble per se, then money flows into the stock market. But the stock market's so high right now that I could see your concern. People might get fearful and run for the hills completely. So stay with us. We have one more segment with you. Lots of great questions. And you too, our Income Generation members, you stay with us too. We have a lot more from my good friend, Paul Smith. We'll be right back. Welcome back to the Income Generation. I'm David Scranton. And yes, we are still here talking with author and investment specialist Paul Mladjenovic, aka Paul Smith. Paul, thanks for sticking around one more time. So you struck a nerve with me here now, so I'm going to push back with you a little bit. Let's have some fun. I agree with concerns about the stock market. I think that if interest rates go up, then the stock market on its own could drop because interest rates affect valuations. The higher the interest rates are, the lower stocks are valued on a present value of cash flows. But I'm not expecting a bond bubble. So tell me more about why you see that happening.
Well, when I take a look at the across the landscape, a lot of areas are at great heights right now. The auto subprime is at a high level. Mm-hmm. Consumer debt, corporate debts are at elevated levels, et cetera. And to me, debt could be a real problematic issue. Now, if the economy grows and people can be able to service this, to me, that maybe we can muddle through it. But in the meanwhile, if the Federal Reserve feels that the stock market and the economy are doing just fine, they could start giving the rationalization for increasing interest rates, and that's going to have really a systemic effect in many respects. So, and the thing is this: could we go through 2018 without a bond bubble popping? It's a possibility. But I just feel that it's a heightened area that people should be concerned about.
But when you talk
this is why for stock investing, I prefer dividend investment stocks versus regular stocks.
Oh, I agree completely on the stock side, absolutely. But when you start talking about spending going up, if or debt going up, personal debt, if you're talking about another 2006, 2007, even if it's not a financial crisis, it's a recession, then ultimately the Fed's going to have to lower interest rates again, and that creates a tailwind for bonds. So I guess I've looked at it saying, gosh, if that happens, we have a tailwind for bonds. If things keep going up, there's so much money still on the sidelines that's going into the stock market and going into bond market that it's really keeping the stock market artificially overinflated, and it's keeping the bond market from really having a bond bubble. Because to be a bond bubble, it actually has to burst at some point. Your thoughts?
Well, this is why I think, like, for example, the real Achilles heel is going to be in the junk bond areas. And those are starting to show some cracks.
Especially if
and
the
that's
stock
where
market
it's going to
takes a
start.
big dip. Absolutely.
So there's plenty of junk bonds out there. People are looking for yield. And so for me, there's some worries there. Now, don't get me wrong. If the interest rates stay flat for the rest of the year and the economy starts to grow, then I would be much less concerned about issues in the bond market. And for me, the stock market, but keep in mind this, even if it causes a pullback in the stock market, I see it as a buying opportunity. Mm-hmm. I think very long term, the stock market can keep on going unless there's massive policy changes at the federal level that'll start to mitigate and pull that back.
I agree completely. If you're going to be in the stock market, dividend-paying stocks are the option. Unfortunately, a lot of people, whether you're investing for income, you can't get the income you need from that. Thanks so much for being on the show today. We've got to run. It's been my pleasure.
Thanks again, Dave.
I'd like to thank both our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. As expected, in President Trump's first State of the Union address last week, he devoted a good deal of time talking about his tax cuts and how they're going to kick economic growth into high gear. And that could actually happen. There's no doubt the economy has been moving in the right direction, or that the pace of growth has picked up since the election. But there's also little doubt that the stock market's post-election growth has outpaced the economy's growth by a pretty significant margin. And it's a given that at some point, the markets have to make fundamental sense again. As we saw on today's show, compared to historical norms, this economy is far from booming. In fact, it's not yet even back to an average level of growth. It still has a long way to go. And while there's a chance that his tax cuts and other factors could get us there, there's by no means a certainty. What is certain is that with froth still building the market and the market still up, now is an ideal time for investors within 10 years of retirement or who are currently retired to consider, if they haven't done so, reducing their risk. In other words, to take some chips off the table while the pile is still big, to protect them and to put them to work generating the income that you need to enjoy retirement. Thanks for watching. Bottom line is, if you're close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and thanks again. We'll see you next week.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.